DBS just released their Q2 2025 results and hit all-time record highs. But here's what most investors are missing. While everyone's celebrating the 39% dividend bump, I'm seeing warning signs that suggest smart money might be taking profits right now. Are you buying at the peak or positioning for the next opportunity? The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends. Today, we're doing a crucial deep dive into DBS's Q2 2025 results. Stick around to see what it really means for your portfolio. I'm taking you through every major slide from their earnings presentation. We'll analyze the profit drivers, segment performance, balance sheet strength, and, most importantly, what this means for your CPF and SRS investments. Slide 1, Executive Summary. Strong numbers, hidden concerns. All right, let's look at Slide 1, the Executive Summary. DBS delivered pre-tax profit of $3.39 billion, up 5% year-on-year, with net profit at $282 billion. Total income rose 5% to $573 billion despite challenging conditions, including sharp SORA and hybrid declines. Here's what catches my attention. Pre-tax profit grew 5%, but net profit only grew 1%. That 4 percentage point gap tells us about rising costs below the line, taxes, provisions, and other expenses eating into shareholder returns. For CPF investors, this matters because it affects long-term dividend sustainability. The return on equity sits at 17% for the first half, which is excellent by regional standards. The CET1 ratio of 17% shows fortress-like capital strength. But here's the key question. At current prices, near $49, are you paying too much for future growth? Slide 2, Profit Bridge Analysis. The real growth story, moving to Slide 2, the year-on-year profit bridge. This slide reveals the true drivers behind DBS's performance. Net interest income fell 4% due to lower rates, but fee income surged 11% and markets trading income exploded 124%. Think of this like a hawker stall that's making less money from its main dish, but compensating by selling more drinks and desserts. It works short-term, but markets trading income is volatile. When market conditions calm down, this income source could disappear overnight. For Singapore investors, this shift matters. Traditional banking is becoming less profitable due to falling interest rates, pushing DBS toward fee-based services. This is good for diversification, but introduces earnings volatility that didn't exist before. Slide 3, Sequential Trends, Momentum Cooling. Slide 3 shows quarter-on-quarter performance, and here we see momentum slowing. Net profit fell 3% from Q1 to Q2, with fee income down 8% sequentially. This suggests Q1 might have been artificially strong due to market conditions. For wealth management clients and CPF investors, this sequential decline in fee income is particularly relevant. It shows that DBS's star business segment isn't immune to market cycles. The good news? Credit costs fell sharply, with management writing back $17 million in general provisions. Slide 4, Half-Year Records. But at what cost? Slide 4 covers the first half summary. DBS hit record pre-tax profit of $683 billion, up 3% year-on-year. Markets trading income surged 80% to $781 million. Impressive, but unsustainable at these levels. The concern for long-term investors, allowances for bad loans rose 62% year-on-year. While still manageable at 12 basis points, this suggests management is preparing for tougher economic conditions ahead. Smart money always watches what banks are setting aside for future losses. Slide 5, Net Interest, Margin Compression, the core challenge. Slide 5 focuses on net interest margins. DBS's bread and butter. The group NIM compressed from 2.14% to 2.05%, a 9 basis point decline. For a bank of DBS's size, this represents tens of millions in lost annual revenue. However, DBS managed this compression better than regional peers through proactive hedging and strong deposit growth. Their commercial book NIM actually held up relatively well. For CPF investors thinking long-term, this shows management's ability to navigate rate cycles, but the structural headwinds remain. Slide 6, Balance sheet growth. Steady but unspectacular. Slide 6 covers loans and deposits. Gross loans grew 3% year to date to $439 billion, while deposits rose 5% to $574 billion. The loan-to-deposit ratio sits at a conservative 75%, providing ample liquidity. This modest loan growth reflects the cautious economic environment across Southeast Asia. For SRS investors, it means DBS isn't taking excessive risks, but it also limits future profit growth potential. The strong CASA deposit growth is positive. It shows customer loyalty and provides cheap funding. Slide 7, Fee Income Powerhouse. The Singapore Advantage Slide 7 breaks down fee income, and this is where DBS truly shines. Total fee income rose 11% year on year, led by wealth management fees, up 42%. This reflects Singapore's growing status as Asia's wealth hub. For local investors, this trend is crucial. As more ultra-wealthy individuals move to Singapore, DBS captures wallet share from global private banks. Every dollar in fee income is less cyclical than lending income, providing more stable earnings for dividend payments. Investment product sales rose 24%, cards grew 8%. This diversification makes DBS less dependent on interest rate cycles. For CPF portfolios, this business mix evolution supports long-term dividend sustainability. Slide 8, Segment Performance. Tale of two businesses. Slide 8 reveals segment divergence. Consumer and wealth management income grew 4% to $5.28 billion, with AUM hitting record $442 billion. Meanwhile, institutional banking contracted 4% due to subdued trade flows. This shift toward wealth management is exactly what Singapore investors want to see. It's higher margin, less cyclical, and benefits from regional economic growth. For SRS investors, DBS becomes a proxy for Southeast Asian affluence and capital migration trends. The record AUM of $442 billion represents sustainable, fee-generating assets that aren't sensitive to quarterly interest rate movements. This is the foundation for future dividend growth. Slide 9, Trading Windfall, Opportunity, and Risk. Slide 9 covers markets trading income, the star performer with 80% growth in the first half. Treasury customer income also rose 14%. This shows DBS's ability to capitalize on market volatility. But here's the reality check. Trading income is inherently unpredictable. When market volatility fades, this income source could contribute 15 to 20% less to earnings growth. For conservative CPF investors, don't bank on these levels continuing indefinitely. For even more granular data, detailed financial models, and a full written breakdown of this DBS report, including an extended valuation analysis, make sure to check out our Substack. The link is right there in the description. Slide 10, Capital Fortress, Dividend Security. Finally, Slide 10 covers asset quality and capital strength. The NPL ratio improved to 1% from 1.1%. Allowance coverage stands at 137%, and the CET1 ratio remains at 17%. Most importantly, the quarterly dividend jumped to 75 cents per share, a 39% increase. At current prices around $48.85, this translates to roughly a 6.14% dividend yield, well above CPF ordinary account rates of 2.5%. For Singapore tax residents, these dividends are completely tax-free, making DBS attractive for retirement planning. Iggy's overall assessment: quality stock, premium price. Based on this comprehensive analysis, here's my verdict. DBS remains the gold standard among Southeast Asian banks, but the valuation context has changed dramatically. With a forward PE around 12.4 times versus sector peers at 9 to 10 times, and a PB ratio near 1.9 times, most of the easy upside is already priced in. Consensus analyst targets hover around $46.70 to $47.20 below the current market price. Out of 18 analysts, very few recommend outright buy ratings. This tells you something about near-term upside potential. Should you buy, hold, or sell DBS right now? My rating: hold. For current shareholders, enjoy the dividends and hold for the long term. The 6.14% yield provides solid income backed by fortress-like capital ratios. For new investors, patience is key. At $48.85, you're paying premium prices for future growth that may not materialize quickly. Wait for a correction to the $44 to $45 range for better long-term returns. Key risks include structural margin compression, volatile trading income, and increasing regional competition. For CPF and SRS investors, consider dollar cost averaging over 6 to 12 months rather than lump sum purchases. The strategic advantages for Singapore investors are clear: tax-free dividends, strong wealth management exposure, and capital safety. But unless you get a correction, current prices lock in only moderate future returns. So we've dissected DBS's Q2 2025 results, and I've given you my personal take on what it means for your investments. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Next, check out my deep dive comparing all three Singapore banking giants, DBS, UOB, and OCBC, to see which offers the best value in today's market environment.